Welcome to #FinanceMaster. Kick back, relax, and enjoy this week's show.
Hello, everyone, and welcome to another episode of the #FinanceMaster show. It's been 2 weeks since we had the last episode, but today's show is going to be special, or at least there's the opportunity for it to be special. We are trying a new feature. It's not a LinkedIn feature, it's something that we are kind of adding in to the mix. Maybe you've been with the show since the old days where we did it as an audio show on LinkedIn. Perhaps you remember people coming up on stage, sharing their thoughts, perspectives, opinions, and asking questions to today's show. When we went live on LinkedIn, we lost that feature. But today, we'll try to bring it back. We'll get back to you with more details on this, but already in the event description, and we'll share it in the comment later, there's a link that you can click to join me here on stage to discuss today's topic. All you need to do is be ready on camera and put in your name, title, and ideally also company as well. But even if you're not employed right now, you're of course welcome here as well. So it's something I've not seen before. Yes, of course, you can have guests on your LinkedIn Live, but not people from the audience. So I'm counting on you to make this a special episode. Let's see, get someone up here. If we don't, we'll definitely try again next week because this is what's going to make this show special. You are what is making this show special. But before we can begin, let's just repeat the rules of the show. We are live and we are recording it to be released as a podcast on all your favorite channels. Just search for #FinanceMaster and you will find it. We're also streaming live to YouTube, and we will release the episode in some weeks on YouTube as well, so you can watch it back, gain some insights, watch your favorite snippets, and always be updated on the latest trends in finance and accounting. This is extremely exciting. So today's topic is just another one from the book, if you will, but we are talking about value drivers and how finance professionals can drive value. So before my holiday, I had a week of holiday, we talked about revenue growth. Today, we'll talk about costs. Asking the question, who's better to drive down costs than finance professionals? If you need to drive down costs in your company, executives typically go to one place for analysis and follow-up. No, it's not consultants. It's to finance professionals, you guys and girls out there. We know how to analyze the company's cost structure in detail and discuss ideas with the relevant stakeholders to drive down costs. We're not doing it alone, but often enlist operations, procurement, HR, and others. Today's show will show you how finance can drive costs down. Cost efficiency is one of the 4 key drivers of shareholder value creation. We gave an overview of this in the introduction to this series. In today's show, we will explore the underlying drivers of cost efficiency and discuss specific analyses and initiatives that finance professionals can drive and implement. We probably all know the old saying, it costs money to make money. And that's true for all companies. Naturally, cost structures and line items vary greatly by industry, but companies have costs, sometimes even without revenue. That's a fact. We're definitely not going to explain all cost items here, but we have highlighted some main ones. So we have COGS, or cost of goods sold, or more broadly speaking, variable cost. These are directly related to what the company is producing. This is typically shown as a unit cost to help understand how much it costs to produce one unit of the company's products. Then we have SG&A, referred to in many different ways, sales, general, and administrative costs, or more broadly speaking, fixed costs. Of course, you could have office, location, and other costs there in as well. They are only indirectly related to what the company is producing. This also means they are more inflexible to change. This is typically shown by location or department and rarely as a unit cost, since there's no direct relationship. Finally, we have interest and taxes. These cost types are often referred to as below the line and are typically not considered for profitability analysis or as part of the company's operations. Nonetheless, there are cost items subject to optimization and should be in finance scope for driving efficiency. These drivers, especially COGS and SG&A, can be split into numerous elements of optimization. In manufacturing, for instance, there's a plethora of operational drivers that impact COGS, and it's critical that the operational team has insights into these. The challenge is rarely to track the drivers, but rather to separate what's important from what's not, and link the financial and operational drivers. First, we'll focus on ways to optimize the described cost drivers, and then examine specific analyses that finance professionals can perform to provide visibility into their development. But here's the first question for you. And then let's see if we get some people on stage or you just want to put it in the comments, which you're also very much welcome to. And by the way, do let us know where you're tuning in from. That's always appreciated. We usually have people from all over the world, and no other show can replicate that either. But here's the question for you. Are you already involved in any cost reduction initiatives in your company, or have you been involved in such in the past? We are definitely curious to hear from you. Uh, we have we have George coming up here. I don't know if George is going to be on camera. George, are you here? Unmuted, George.
Yes, I am.
Welcome to the stage. If you can put on the camera, that's great. Otherwise, just happy to have you here.
Thank you very much. Thank you.
So, what are your thoughts on driving down costs as a finance professional?
Yes, I agree with you. I'm sorry I didn't put the camera on because I'm working on a project now, and I would like to listen to you as well. Um, so I live. Um, Sorry, pardon me. I will be on the shadow.
All right. No worries, George. Thanks for coming up, nonetheless. So we're just checking in on some of the comments we got so far. We have Emmanuel saying great insights on the role of finance professionals in driving efficiencies. Their contribution are vital for realizing cost savings and fostering innovation. Absolutely. We need to run an efficient business to have resources available to invest. And then we have Hani here saying finance professionals are best suited to drive down cost because they have expertise in analyzing financial data, identifying inefficiencies, implementing cost saving strategies while ensuring financial stability. And I 100% agree with that statement. This is definitely true. So again, let us know where you mean from. If you want to come up on stage, we have plenty more questions for you, but just click the link, join the green room or waiting room, whatever you want to call it, and then we'll bring you up a bit later. That's how it goes when you try out new features, but at least we can see it works getting some people up here. So yeah, definitely don't shy away. We don't bite. It's just going to be just like in the good old days. Now you're just up here on camera to make it a bit more lively. But yeah, you can of course join as any way that makes sense for you. All right. So how do we drive cost efficiencies? We'll view each driver through a different lens. COGS is seen from a product perspective, SG&A from a department perspective, and interest and taxes as separate line items. So, from a product perspective, product profitability is critical to most companies, but they often find it easier to drive down cost than to increase the price in the market. Products will then be split into separate cost types like components, machinery, labor, and so on. Each requires different strategies to optimize. Component cost, for instance, requires strong sourcing practices, whereas machinery costs involve considerations for buying or leasing and maintenance costs. Labor costs are yet again different and involve everything from negotiating salaries to learning and development to develop your staff. On the SG&A side, we have departments, and just as an example, could be broken down into different ways. So most departments employ staff not directly involved in producing the company's products. Still, there are significant differences in how closely they are engaged in driving the company's top line and profitability. Sales staff, for instance, would be out growing the business, whereas finance staff would handle control and compliance tasks necessary to do business. Reducing costs by department typically requires separate action plans. However, comparing departments across locations, for instance, or putting a headcount or FT full-time equivalent in relation to product volumes can be helpful across all departments because this gives you a productivity measure, which we'll get back to. On interests, this is often a line item fully controlled by finance, and as such, it should be much easier to optimize. It is tightly linked to the company's capital structure and the risk profile that management seeks. What's important to understand is that for most companies, this is not a core business item, and as such, not one that will be considered for profitability purposes. If you're a bank, for instance, it's of course different. And finally, taxes, another line item often more in finance control. However, it's also dictated by where the company does business. Every country has its tax rates and structures that companies should know about. Moreover, doing business internationally involves transfer pricing considerations as well. Reducing the tax cost can often be done by moving around asset ownership and company headquarters, for instance. Still, it's not something that companies do lightly, as they also need to consider the public opinion. Now, I've been part of several cost reduction initiatives. One was called the Joint Cost Plan, and it was a collaboration between operations, procurement, and finance. So in finance, we would follow up on and report on the savings. And I took a more prominent role in these initiatives by facilitating workshops and joint brainstorming sessions to share good ideas across to help operations managers find new ways of getting savings. I also visited many of the operations managers across the region for which I was responsible. The result was a saving for the year of $38 million. That is around 4% of the total cost base. So it was not insignificant. Of course, it wasn't earth shattering either. But considering that our vendors would push for cost increases yearly, this was definitely not easy. Okay? So, question for you: what analysis would you suggest we do as finance professionals to generate insights on cost reduction opportunities? Naturally, we're always watching cost developments in our company. We see this in our variance analysis leading to the monthly management reporting. We highlight the variances, comment on them, and ask how to improve the situation. However, we need to go beyond simple variance analysis to derive insights on how to drive down costs. Here are four examples of such analysis. First is benchmarking. This is a very effective way of seeing which departments or locations or other unit types are spending more than necessary. Benchmark similar units internally or externally if possible to learn where there is above average spending that could be targeted for cost cutting. Productivity. Sometimes cost levels vary across units. For instance, it could be countries where there are low cost and high cost countries. So making a cost-based benchmark analysis based towards low-cost countries versus high-cost countries could be a bit challenging. Instead, you can consider conducting a productivity analysis where you use headcount or FTEs instead of costs as highlighted above. A person is a person no matter the cost, so to speak, if they perform the same role. Yet, if a high-cost country has lower productivity than a low-cost country, you have a better case or cause for initiating cost-cutting projects because you would expect them to do the same job to be equally efficient, if you will. Then there's asset ownership. Should you lease or own assets? If you own them, where should they be owned? And so on. There are many considerations for deciding on asset ownership. The short-term view might simply look at the absolute cost level hitting the P&L, whereas a long-term view might also consider the total cost of ownership. And finally, we have outsourcing/offshoring. In cases where activities don't require closeness to where the company does business or is not a core business activity, offshoring or outsourcing should be considered. This requires both business and process understanding to determine in detail. But at the very least, you can start asking questions about it. For instance, many companies have already offshore production and various supporting activities like finance and HR. This is by no means an extensive list. I asked ChatGPT, just like I did last time, to give me a list of 10 other analyses to prepare. And it quickly gave me these. You have activity-based costing, process mining analysis, cost-benefit analysis, root cause analysis, Pareto analysis, 80/20, benchmarking was here again, total cost of ownership analysis, spend analysis, could it be category spend or else? Time-driven activity-based costing, just to make the acronym very long, TDABC, and supply performance analysis. But you could ask again, and they will give you more and more and more. So there's plenty of analysis that you can do. As with driving revenue growth, we're not short on activities to drive down costs. We need to start working on it though, and it starts today. If you haven't already started, of course. I once did a benchmark analysis of some drilling rigs to understand why one of the rigs had significantly increased cost over 5 years. And these were 5 very similar rigs. It turned out that the rig manager had saved on maintenance to hit some financial targets, which eventually put the rig's operational uptime at risk, forcing a new rig manager to overspend on the rig significantly. We couldn't save on cost from this analysis because we had to spend on maintenance. We could undoubtedly dispel unwanted behavior in the company. Final question for you today. Do you have any concrete examples of cost reduction initiatives that you have participated in? We also have a LinkedIn user here, account see who it is, says, good info, exploring ways for operations to be more lean is a good way to reduce cost. Reducing fixed costs without jeopardizing key aspect of the business is also ideal. Absolutely. I think what we want to try to avoid when we do cost savings initiatives is to not lay off people, right? Because that's kind of the most brutal way of doing it. Sometimes that is necessary for various reasons, but not something that we should take lightly for sure. So those are some good ways, some good suggestions. But please do keep the comments coming in, and if you want to come up at the end to share perspectives on this topic, feel free to do so as well. Just wait for a short while in the green room or the backstage, whatever you want to call it. So, how to get started on driving down costs, I guess, is the question left here. And I know we said to go beyond simple variance analysis, but this is typically where it starts. Look at your latest monthly management report to understand where you have the largest cost variances. Then dig into that area using some of the techniques we have described in today's show. Use your findings to discuss with the relevant responsible teams what can be done to make the area more efficient. And don't just go and tell them, please drive down cost. Be part of the solution as well. It's not rocket science. And I'll guarantee you, from doing these analyses, you will undoubtedly uncover unknown issues, or you are sort of find ways to push people to act on them, right? So this is an area that all finance professionals should definitely take serious, should definitely get involved in, because executives are looking at us. They may not ask us to drive revenue growth. We could also do that, but they will definitely be looking at us to drive cost savings initiatives. The more we can do that by avoiding laying off people, probably the better. But lots of great techniques have been shared in today's show. Final offer here to come up on stage if you want to join us. I think we do have a few people up here, but we're all kind of learning how it works. But just like in the good old audio days, we are welcoming everyone up here. So as you can see, is a QR code on screen. There's also a link shared in the comments section, both on the event page and in the live stream here. You can click on that. You come into the green room. There's a nice staff there, just not necessarily taking care of you, but just making sure that you get up on stage at the right time. Wait until it's your turn, and then you get up here. Ideally, add your name, title, and company as well. Share your insights. Ask questions to enrich the show. This is what makes it truly special for all of us, and what makes the show unique. And if not today, maybe next time. At least now you know that there's the opportunity to come up here and make the show even more come alive. We are continuing on the Value Driver series also next week, where we'll talk about driving value through the balance sheet, something that we should definitely all consider as well. Why? Because no one else cares about the balance sheet but finance people. So I hope that you will be there next week at 3 o'clock European time, and maybe already now start to think about coming up on stage. We will keep pushing this because I'm sure it's going to be a great way to drive engagement with all of you, and also an opportunity to make the show special. But from today's show, thanks a lot for tuning in. Stay tuned for next week. And if you want to catch up on previous episodes of the #FinanceMaster show, find them in your favorite podcast channels, or go to the #FinanceMaster YouTube channel. We are closing in on 2,000 subscribers over there. So let's keep pushing. I will for sure, and I hope you will too. But for now, see you again next week, and get started on driving down those costs, okay?
You've been listening to #FinanceMaster. Don't forget to subscribe to stay updated on the latest trends in finance and accounting.